So welcome all for today's EFR session. So I want us to open that question, May 2019 question 3B. We'll be doing company reconstruction. And just to remind you, we see that we have two types of company reconstruction. We have internal reconstruction, as well as we have external reconstruction. And you see that the difference between the two is that at the internal reconstruction, there is no liquidation. The shareholders and the debt holders, they just compromise so that they sacrifice their wealth or their claim so as to save the company. But internal reconstruction, this is where a new company is being usually formed to take over the asset of the existing company. Then we say that internal reconstruction is the same as capital reduction. It's also known as the capital reduction scheme. And we see that under capital reduction scheme, how do we prepare the capital reduction account? Capital reduction account. You see that in the capital reduction account, on the credit side, you bring what the shareholders and the debt holders sacrificed. So you bring the ordinary share capital. That's what the shareholders sacrificed. Also, share premium. Also, revaluation gains. And then anything else that the debt holders, for example, the preference shareholders, the creditors, anything that they sacrifice. So you also bring the debt holders sacrifice. So in that case, then on the debit side, you debit accumulated losses. Also goodwill written off. Also revaluation losses. So that's how you prepare the capital reduction account. So now let's do this question, May 2019, question 3B. So we are told that Matatizo Limited has been recording losses for the last few years. The statement of financial position for the company as at that 1st March 2019 was as given below. So you have that. The authorized share capital of Matatizo Limited is composed of 5 million equity shares of shillings 10 each and 200,000 10% preference shares of shillings 100 each. It was decided during a meeting of the shareholders and directors of the company to carry out a scheme of internal reconstruction with effect from 1st April 2019 as follows. Number 1, each equity shares are to be designed as a share of 4.5. So how much was the par value per share? It was 10. It was designed or it was written off to 4.5. So that means every share has ordinary share capital, it had a par value of shillings 10, then it should be designed or to be written off to 4.5. So that means there is a loss of share of how much? 5.5. So how do you account for that? We say that under capital reduction account on the credit side, you show that the shareholders or the ordinary shareholders, they sacrificed their wealth. How many ordinary shares they had? Let's go to the equity. How many ordinary shares did they had? They had 3,000 shares, and then the share were written down to 4.5. That means every share lost by how much? 5.5. So how much they reduced? To get 16,500. Good. That's the wealth that the shareholders sacrificed. Then you are told that the equity shareholders are to accept a reduction in the nominal value of the shares from 10 to 4.5. In addition, the shareholders are to subscribe for a new issue of shares on the basis of 1 share for every 3 held at a price of shilling 6 per share. Then the ordinary shares agreed to effect a rights issue. And what was the term? We are told that in addition, the shareholders have to subscribe a new issue of shares on the basis of 1 share for every 3. Are together? 1 share for every 3. So it's 1/3. How many shares did they had? They had 3,000 shares, and each was issued at 6 shillings. So how much cash did the company receive from the rights issue? You get? Yeah, 6,000. So now this one goes to the cash account, and then you credit the ordinary share capital. Number 2, the existing preference shareholders are to be exchanged for a new 15% preference shares of shillings 100 each, and 500 equity shares of 4.5. The preference shareholders. How much was the preference shareholders? Preference share capital was how much? Was it 10,000? Now they sacrificed their wealth. Now let's be here. Preference share capital. It was how much? They had 10,000. This 10,000 is to be exchanged. Let's read that again. The existing preference shares are to be exchanged for a new 15% preference shares of 100 each. So they were given 55,000 shares each at 100 plus and 500 equity shares of shillings 4.5 each, and 500 shares each at 4.5. So do they sacrifice anything? Yes. If you take 55 times 100, they were given preference share worth that, and then in addition they were given shares worth 500 times 4.5. So in short, they were exchanged with a debt of 77.50. But the preference share capital was how much? 10,000. So that means they sacrificed some of their wealth. So it's 10,000. You minus that, and they sacrificed a wealth of 22.50. Good. A preference shareholder, they are part of the debt holders. Then number three, the 12% debentures are to be converted into 15% debentures. So that means in this case, the debenture holder, they are not losing anything because it was just converted. So in this case, what they did, they need to extend the period, but they increase the interest rate from 12 to 15. Then you're told that a further 1 million of 15% debenture of shillings 100 are to be issued at 70, at 75. Yeah, that is a further to be issued. That one will not affect our capital reduction account. Number 4, the directors agreed to forego 50% of their loan. Can you go to the equity and liability? Can you see directors' loan? Loan from directors was how much? 5,000. Directors, this is a loan. Are you together? So you're saying that under capital reduction scheme, this is where the ordinary shareholders and the debt holders sacrifice their wealth. And we are told that, let's read again, number 4, the directors agreed to forego 50% of their loan. So directors' loan, they sacrifice their wealth. Directors' loan, 50%. How much was the value of the loan? 5,000. They sacrificed the wealth of how much? 25. So the director agreed to forego 50% of their own. The balance of their own was to be settled by the issue of 400 equity shares or forfeit. They also sacrificed something else. Now let's be here. Their own was 5,000. Are you together? They sacrificed half of it, which is 25. So that means how much is the balance? The balance is 25. And this 25, it was exchanged through the issue of shares. So now let's go through that. The balance of their own is to be settled by the issue of 400 equity shares or 4.5. They were given ordinary share capital, 400 each at 4.5. 400 times 4.5 is how much? You get? 1,800. Are you together? So the balance, they were supposed to be paid 25, but they were given shares worth how much? 18. So there is a difference of how much? 7? Is it 700? Yes. So also directors' loan, they did not only forego 250, they also had a balance of 700. Also, directors' loan again, you take 25, that was the balance that was supposed to be paid, of which they were paid 400, 4.5. So the balance is what they sacrificed. of which you get still it's 700. Good. Number 5. The bank overdraft is to be repaid in full. So that one will affect the cash account. Number 6, all intangible assets and accumulated losses are to be eliminated. We say that how do we eliminate asset written off? In short, it's what we call evaluation loss, or the asset, their value was scrapped. So in this case, you debit. So you bring the accumulated losses. How much was accumulated losses? Yeah, accumulated losses was an amount of, yeah, it was 2,000. Also, you're told that all intangible assets and accumulated losses have to be eliminated. Let's go to the assets. All intangible assets. One, we have what? We had goodwill, an amount of 5,000. Can you see patent and trademark? Yeah, patents and trademark, an amount of 500. And then, number 7, creditors accepted to be paid half of the amount due at a discount of 10. Creditor is part of the debt holder. They have sacrificed the other how much? Can you compute that? Creditors. How much was the value of the creditors? It was 2,200. Did they sacrifice anything? Yes, they gave us a discount. Are you together? So creditors accepted to be paid half of the amount. So you multiply by 50. So 50% of 2,200 is how much? 1,100. Of that 1,100, due to a discount of amount due at a discount of 10%, then they give us a discount of 10% of the amount we are paying them. So 50% of 22, that means we pay them 1,100, but of that 1,100, you raise the discount of 10%. How much do you get? Is it 990 or 110? 110, Yeah, because it's 1,100 times 10%. Right together? Yes. Then, number 8, assets are to be adjusted to their fair values by the following amounts. So, in this case, we had a revaluation. Plant and machinery, did it get gain or loss? Was it a gain or loss? Plant and machinery. A loss of how much? A loss of how much? 20? 23,900. Now, can we read that statement again? Assets are to be adjusted to their fair values by the following amount. It was not revalued to. We are given it was adjusted by the following amount. So that means printed machinery lost by 61, equipment that 250, receivables 1160, and also inventory an amount of 460. It was not revalued to, it was revalued by. And in that case, in this case, they're not saying that it's a fair value gain or loss. But in this case, whenever you're facing reconstruction or facing financial difficulties, you don't expect the asset to be revalued upward, rather they be revalued downwards. Good. Number 9, the share premium account is to be utilized for the purpose of capital deduction. Share premium, debit, credit. You credit, yeah, the share premium. In this case, the shareholder who are sacrificing their wealth. Share premium. And we say that for the share premium, you only factor in what they had at the time of reconstruction. The new, the right issue will not affect the share premium in the capital deduction. So how much was the share premium? It was 4,000. For example, in this case, the shares, how much is the par value of the shares? The shares were written down to be redesigned from 10 to 4.5. And then, remember we had a right issue, of which we issued an amount of, how many shares did we issue? Hey, can we go back to note number 1? Each share has to be designed to shillings 4.5. The equity shareholders are to accept reduction in the nominal value of the share from 10 to 4.5. In addition, the shareholders are to subscribe for a new issue of shares on the basis of 1 share for every 3. And this is what we did here, the right issue. For every 3, you get 1. What about 3,000? You get how many shares? Which was other? 1,000 shares. Each at how much? 6. So that means we got a cash of 6,000. So what do you debit? What do you credit? What do you credit? You debit cash account with an amount of 6,000. Then you credit number 1, ordinary share capital. Remember, I said that the ordinary share capital is always recognized at par value. So we issued 1,000 shares, and the par value is now 4.5. That means we issued at a premium. 1,000. The par value was the share was designed to 4.5, but we issued each share during the right issue at how much? 6 shillings. Are you together? So 4.5 to 6, that means there was a premium of how much? 1.5. Are you together? So you credit ordinary share capital by 45, and then you credit the share premium by how much? 50. Now this 15 will not affect your share premium in the capital reduction. Required capital reduction account for Matatizo Limited after completion of the internal reconstruction. Actually, they only wanted this, so they don't have to present that. So was it a successful reconstruction or not? So let's get the balancing figure. In case it balances, we say that that's what we call as successful reconstruction. In case it doesn't balance, the balance becomes the capital reserve. Here I'm getting 26,060. So here I get 7590, the balancing figure. That's what you call capital reserve. It's a capital reserve. That means they reduce more than what they had lost. So you can copy that. You can just take a screenshot. Let's do another question. November 2016. Question 3. November 2016, question 3. So we start with part A, question 3A. Explain 4 differences between internal reconstruction and external reconstruction. So let's write somewhere. The differences between internal and external reconstruction. Number one, internal reconstruction requires court confirmation. Internal reconstruction requires court confirmation. While external reconstruction requires no court confirmation. Yeah, you see, in internal reconstruction, we have to reduce the share price or the par value, maybe from 10 to 4.5. And the company, remember what you did in company law, that the company cannot reduce the share below the par value, not unless they sanction, they have a court sanction. Number two, another difference. Internal reconstruction requires no liquidation. While in external reconstruction, liquidation takes place. Number three, in internal reconstruction, no new company is formed. In internal reconstruction, no new company is formed. While in external reconstruction, a new company is formed. Yeah, those are some of the differences between the internal reconstruction and external reconstruction. Good. So now let's do part B. The following is a summarized statement of financial position of P Limited as at 30th June 2016. So we have that. The court approved a scheme of reorganization submitted by the debenture holder and agreed upon by other interested parties to take effect on 1st July 2016. Details of the approved scheme are as follows. So I told that the 6% debenture holders are to have their interest paid. So can you go to the required? Let's go to the required. Number one, they want the capital reduction account to record the scheme of capital reorganization. So number one, present the capital reduction account. Number one, the 6% debenture holders were to have their interest paid in cash and to take over part of the freehold property. And then you are told that book value 160 at a valuation of 190, 192 in part repayment of the their holdings. The 6% debenture holder are also to provide additional cash of 208 million secured by a floating charge on the company asset at an interest rate of 12% per annum. Will that affect the capital reduction account? Yes. So can we do that statement again? The 6% debenture holders were to have the interest paid in cash and take over part of the freehold property. Its book value is how much? 160 at a valuation of 190, 192. So in this case, we have a revaluation gain or a revaluation loss. There is a revaluation gain. Yeah. So gain on transfer of property property. We have transferred them to the debenture holders. The book value was 160, but we transferred at a value of 192. So it's 192 minus 160. So there's a gain of how much? That too. Remember, I said that revaluation gains, revaluation losses. Then we are told that the 6% debenture holders are also to provide additional cash of 208 million secured by a floating charge on the company assets at an interest rate of 12%. So that one will affect cash, will not affect the capital reduction account. Number 2, patent and goodwill are to be written off. Patent and goodwill are to be written off. So to be written off, that means you debit. So we have patent. And also we have goodwill. How much was the value of the patent? Yeah, 244. What about goodwill? 224. Yeah, patent and goodwill are to be written off. 120 million is to be written off inventory, and 93.6 million to be provided for bad debt. So we have inventory written off. That's a loss of asset, value of the assets, with an amount of 120. And also we had a bad debt. Bad debt, that means the value of the trade receivable is reduces. So bad debt, we provide an amount of 93.6. Then the remaining freehold property is to be revalued to 620 million. The remaining property, is it a gain or loss? Yeah. Gain on property, it's a gain. How do you know it's a gain? It's very easy. Now let's be here. But to that, the remaining freehold property is to be revalued at 620. So you'll take it was revalued to 620. You compare against the book value. How much was the book value? Can you go to the freehold property? It was an amount of 680. You deduct, note number 1. The 6% debenture holders are to have their interest paid in cash and to take over part of the freehold property. Book value is how much? 160. Remember, of this 680, we transferred 160. So the remaining, you take 680 minus 160, you get? Is that 520? That's 520. So the value was 520, but was revalued to 620. So there's a gain of how much? 100. Then number 3. The directors were to accept settlement of their loans of up to 90% thereof by allotment of ordinary shares. So in short, the directors' loan was converted to ordinary shares at par, and 5% in cash. The balance of 5% was to be what? To be waived. So will it affect? In short, the directors sacrificed 5% of their own. So directors' loan, 5%. How much was the director's loan? 160. That was the sacrifice because 5% was waived. So is it 8? Yeah, it's 8. Can you read that statement again? That directors are to accept settlement of their own as up to 90% thereof by allotment of ordinary share and 5% in cash. The 5%, the balance of 5% was to be waived. So that means if to be waived, that one is utilized in the capital reduction scheme. Number 4, the trade payable were to be paid 0.1 in every shillings. So in short, it's like 10%. It's 0.1 for every 0.1 for every 1 shillings to maintain and obtain an extension of the credit period. In this case, they sacrifice nothing. It's only that they said that, can you pay me 10%? Once you pay the 10% of my loan, the balance I give you an extension of the period. So that one does not affect the capital reduction. They never lose anything. Number 5, the bank has sanctioned an overdraft limit of 10 million to provide the working capital. Number 6, the 6% preference dividend are 4 years in arrears, of which 3/4 are to be waived. What does that mean? The preference shareholders are sacrificing 3/4 of their dividends. Are you together? So preference dividends. We are told that the 6% dividend were 4 years in arrears. So you take 6% of how much? Of 640 You multiply by, they were 4 years in arrears, you get the total preference dividend payable, but they sacrificed how much? I told that 3/4 are to be waived. So 3/4 of that is to be waived. You get 115.2. Good. Then you see, in this case, we are supposed to pay them 6% of 640. So that one is called a preliminary expense, which they need to be paid. So you show it here. So preference dividend, 6% of 640 times 4 years. How much was that dividend? It's 0.06 times 640 times 4, which is 153.6. But of this 153.6, they sacrifice 3/4. Are you together? So 3/4 is what you bring here. So in short, you are trying to get the balances. So 153.6 or 115.2 to determine how much we paid. Are you together? Yes. So this is what they sacrificed, but the total amount was 153. So that means this one will be treated as a preliminary expense. But of these preliminary expenses, they already waived 3/4. So the difference between the two is what now will be paid. Good. Then, let's again, the 6% preference dividend for 4 years in arrears, of which 3/4 will be waived and ordinary share to be allocated at par for the balance. Yeah. So the balance of that will be, I mean, 1/4 will be given, they'll be given ordinary shares. Number 7, the 6% preference shares are to be written down to 7.5. Can you go to the balance sheet? How much was the par value of the preference shares? It was 10. Are you together? It was to be reduced to 7.5. So that means every preference share was by how much? Is that 2.5? Yes, so that means they sacrificed. So preference share capital. So it was reduced to 7.5. So that means every share was by 2.5. How many preference shares they had? Yeah, 64. So they sacrificed around how much? 2.5 times 64, 100 and? Yeah, 160. Good. Yeah, number 7. The 6% preference share to be written down to 7.5 each. And the existing ordinary share to shillings 2 each. And the existing ordinary share to shillings 2 each. So also ordinary share capital, they reduce their claim from how much was the par value of ordinary share? Was 10, was to be written down to 2. That means every share was by how much? 8. So you take 8, you multiply by, let's go to the balance sheet. How many ordinary shares do we have? Yeah, we had 120 ordinary shares. So it's 120 ordinary share, and every share, the shareholders are sacrificed 8 shillings per share. You get how much? 6? Sorry? Yeah, 960. Good. Then after that, all the ordinary shares are to be consolidated into shares of 10 each. So will that affect? So now let's do share consolidation. That's very easy. Share consolidation. We had 120 shares. Are you together? Which was written down to 2 shillings. Are you together? So that means the share capital will be how much? 240. That was the remaining. But we are told that all the ordinary shares are to be consolidated into shares of shillings 10 each. So you divide by 10. So that means now we have 24 million shares, each at 10. Good. Then you are told that the rate of dividend in preference shares is to be increased by 10%. So that one will not affect. Number 8. There are capital commitment amounting to 600 million, which are to be cancelled on payment of 3 and a third on the contract price as a penalty. So in this case, it's an outflow. We expect to pay a penalty of 3 and a third. So in that case, it will affect a capital reduction on the credit side, because we see that this way you bring the outflows or the liberation losses. So in this case, we'll have to pay a one-off penalty of how much? 3 and a third. So that's 3.333. You multiply by 600. Can you read that statement again? Number 8. You need to pay a penalty of 20. Anything else? I don't think there is anything else. So let's try to balance that. But we have not yet factored. Can you go to we had accumulated losses. Yes, we never factored in the accumulated losses. So let's factor in accumulated losses. Yeah, we never factored in accumulated losses. How much was accumulated losses? Yeah, 656. Good. And then there is a point we never tackled. Can you go to note number? Yeah, note number 2. Can you go back to note number 2 again? Patent and goodwill are to be written off. Then 120 million of the are to be written off of inventory and 93.6 million to be provided for bad debts. The remaining freehold property is to be revalued at 620, of which we did that revaluation. Then you are told that the investment was sold at the prevailing market value. Then we disposed of. Now the question is, did we dispose at a gain or a loss? Did we have a gain or a loss? So it's very easy. I think we had a gain. Gain on disposal of investment. Can you go to the non-current asset? Are we there? How much was the value of investment? Is it 88? I mean under current assets, sorry. Current assets. Can you see investments? Market value is how much? 224, but the net book value is 88. Now, can we go back to note number 2? Note number 2, the last sentence, that the investment was sold at the prevailing market value, and the market value is 224, but the net book value was how much? 88. So there is a disposal gain. In case it was a disposal loss, you debit. So we have a gain of how much? It's 224 minus 88, and you get 130, 136. So now let's try to balance that. Yeah, you have it's 15, 11.2. Yeah, that one has balanced. So that means we conducted what we call a successful reconstruction. Good. It was a successful reconstruction. So you're through with part 1. Let's go to part 2. Part 2. Part 2. The statement of financial position of P Limited as at the close of the business on 1st July 2016, immediately after effecting a scheme of reorganization. So we present the balance sheet. P Limited. Statement of financial position as at 1st July 2016. So we start with the assets. Non-current assets. Let's go to the balance sheet. We have freehold property. How much is freehold property? Yes, you are given that information. Can you go to note number 2? Patent and goodwill are to be written off. 120 is to be written off inventory, and 93.6 is to be provided for bad debt. The remaining freehold property is to be revalued at 620. So our freehold property is 620. Then we had plant. Plant was not affected. And since the plant was not affected, the value remained to be 80. Then we go to the current assets. So for the intangible assets, remember the patent and the goodwill were written off. That will not be presented here. Let's go to the current assets. Under the current assets, we have inventory. How much is inventory? 680 minus, we had some inventory written off, an amount of 120. Then we also had account receivables. Account receivables. And for the account receivables, we had 776. Remember, we had bad debt. Yeah, we have to provide a bad debt of 93.6. And then we have investment was disposed. Are you together? Yes, that will not affect. But we also have cash. So first of all, let's work with that. 680 minus 120, you have 560. Then 776 minus 93.6, you get 682.4. We'll come back to cash. Let's go to equity and liability. Under equity and liabilities, we have ordinary share capital. We'll come back to that because we have to compute that. Also, we had preference shares. How much was the preference shares? Preference share, we had 640 minus they sacrificed their wealth. Let's be here. We had preference share capital. Remember, they sacrificed 2.5, an amount of 160. So what do you get? You get 480. Or alternatively, you can do this. How many preference shares did we have? We had 64. Then we're written down to 7.5. So you multiply by 7.5. 64 times 7.5, do you still get 480? Now let's go to the non-current liabilities. Non-current liabilities. And non-current liabilities, we had what? We had debentures. We had 6% debentures. How much was the 6% debentures? Was it 600? Now let's go to note number 1. Note number 1, you're told that the 6% debenture holders were to have their interest paid in cash and to take over part of the freehold property. Book value is 160 at a valuation of 192. So you raise 192. So how much will be the remaining balance? 600 minus 192. You get 408. Then still at note number 1. The 6% debenture holder are also to provide additional cash of 208 million secured by a floating charge on the company asset at an interest rate of 12% per annum. So you have another 12% debenture issued. An amount of 208. Good. So let's go to the current liabilities. Under the current liabilities, what do we have? We have account payables. Account payable. How much was the account payable? 400 minus. Can we go to note number 4? Note number 4. The trade payable are to be paid 0.1 in every shillings to maintain and obtain extension of the credit period, we paid them 10% or 0.1 for every shillings. So you raise what we paid them, it's 0.1 for every shillings, and the starting balance was 400. So it's 400 minus 40, you get 360. Then let's go to the current liability. What else do we have? Bank overdraft. Can you see bank overdraft? Leave that. I'll show you how to adjust for that. Debenture interest. That one is not a liability because we paid in cash. Can you go to note number 1? The 6% debenture holder were to have their interest paid in cash. If we paid them, that means it ceases to become a liability. But we also have accruals. Accruals was how much? 80. Good. So we have 2 items we need to compute. Number 1 is cash. So let me show you how to determine the value of the cash. So we present cash account. Cash account. Sorry. So, so for the cash account, do you have any cash? No. Now, can we go to note number 1? The 6% debenture holders were to have their interest paid in cash and to take over part of the freehold property at a valuation of 192 in part repayment of their own. The 6% debenture holder are also to provide additional cash of 208. Are we together? So we had cash through the issue of debentures, an amount of 208. Then let's go to note number 2. Patent and goodwill are to be written off. 120 is to be written off inventory, and 93.6 million is to be provided for bad debt. The remaining freehold property is to be valued to 620. The investment was sold at the prevailing market. We sold the investment at their prevailing market rate. And how much was the market rate? Yeah, it was 220, 224. Those are the inflow we had. Then you raise the outflows. Which one is easier? Let me open for you the T account. I think you'll understand T account better. 224. Then let's credit. Do you have any outflows? Yes, number 1, you had the bank overdraft. So let me just call it cash and bank account. Did you have any bank overdraft? Let's go to the non-current to the current liability. We had bank overdraft of how much? 312. Any other outflow? Yes, note number 1. The 6% debentures were to have the interest paid in cash. So we have debenture interest. We paid in cash. How much was it? Let's go to the current liability. Yeah, it was 36. Then, note number 3. The directors were to accept settlement of their own as up to 90% thereof by allotment of ordinary share at par, and 5% in what? Cash. So directors' loan, 5% was paid in cash. So 5% of the directors' loan was 160. Is that 8? We have 8. Then note number 4. Trade payable are to be paid 0.1 in every shillings. So we paid trade payable 0.1 for every shillings, of which the trade payable was 400. So that means we paid them how much? 40. Then number 7. Let's go to note number 7. Not number 7, I mean number 8. Number 8. There are capital commitments amounting to 600 million, which are to be cancelled on payment. 3 under that of the contract penalties price as a what? Penalty. So we had a penalty. The one we computed in our capital reduction account, and we had a penalty of how much? 20. So how much do we expect to be our balance carried down? If you're going to pay a penalty, remember that's an outflow. So you take 208. I'm getting a balance carried down of 16. Are you getting that? So we had a cash of 16. Then another thing we need to compute is the ordinary share capital. Let's determine ordinary share capital. Ordinary share capital. What did we have? So we start with the capital balance brought down. How much was the capital balance brought down? Or you can just, okay, just go through point number 7. The 6% preference share to be written down to 7.5 each. And the extension, and the existing ordinary shares to be written to 2 each. Are you together? So that means how many ordinary shares did we have? Go to ordinary share capital. Was it 120? It's 120 shares. Are we together? Each at 2. It was written down to 2, but later we consolidated them into 10. But that one will not affect. Are we together? Yeah, that one will not affect our share capital. So we have 120 times 2, or you do this. You take 1200. You take the ordinary share capital. Was the ordinary share capital 1200? 1200, you minus the ordinary share which was reduced. So let's go to capital reduction account. The ordinary share capital that was reduced was an amount of 960. So how much was the balance? Is that 240? Yeah, it is the same as 240. Then we showed some shares. Let's go to note number 3. Number 3. The directors were to accept settlement of their own as to 90%, therefore by allotment of ordinary shares. So directors, we gave them shares to clear off their loan at magnitude of 90%. So we take 90%. How much was the director's loan? 160. They were allotted shares. So 90% of 160 is how much? So that means we should shares worth how much? 0.9 times 160. You get 140. 144. Do we have any other issue of shares? Yes, let's go to note number 6. The 6% preference dividend are 4 years in arrears, of which 3/4 are to be waived and ordinary shares to be allocated to pay for the balance. So preference dividends, how much was the preference dividend? We're told that it was 4 years in arrears, of which we took 6% of 640 times 4, of which we got 153.6. Then you are told that 3/4 was waived. The balance they were given share. So the balance is how much? 1/4. Good. You get that 8.4. I don't think we had any other issue of shares. So what do you get now? You get 422.4. So the ordinary share capital is 422.4. Yeah. Now it has balanced 1958.4, 1958.4. Now, that question, the way it is, that was what was repeated in the last sitting. They changed nothing, including the figures. So what I have done, that's what you're supposed to do in the last sitting. A lot of students failed in that question. So write it as an assignment, go and try this question. They might repeat it again. November 2020, question 4B. Question 4B. Actually, it was the same question. Yeah, they changed nothing. So you can take a screenshot of that. Then we do one question on an external reconstruction. November 2018, question 2. November 2018, question number 2. B Limited and H Limited are private liability limited companies operating in the service sector. They have been reporting successful trading losses for several years, principally due to severe competition, which has put down pressure on their revenues. The directors of the two entities, who are also the main shareholders, have unanimously agreed to wind up the company's respective business and amalgamate them into one new company to be named S Limited with effect from 1st October 2018. Up to that point, you can be able to tell whether it's an internal or external. This is a case of external reconstruction because in this case, there is a formation of a new company. The statement of financial position of the two companies as at 30th September 2018 are as set out below. We say that when you're dealing with a question on external reconstruction, one, you need to determine the amount of the purchase consideration. And then there are some specific journal entries you need to open. And then how to present the statement of financial position. So given the statement of financial position of the two companies as at 30th September 2018. So let's go to the required. The following ledger accounts in a columnar form to close off the books of B Limited and H Limited in a columnar form. So the first one is realization account. Realization account. And those are the accounts prepared to close off the books of the company in financial difficulties, of which we had two companies, and you are told to prepare them in a columnar format. Hope you remember on how to present the realization account. So we had B Limited, and we had H Limited, B Limited, H Limited. Then number 2, you have to open the preference shareholder sundry member account. Also in a columnar format. And also you have to present the ordinary shareholders. Members account. So let's start with the realization account. How to present the realization account? You say that you debit all assets at the net book value. So let's go to the non-current assets. You debit assets at their net book values. Number 1, we had PPE. But before we present that, first of all, let's compute the purchase consideration. As part of our working, let's determine the purchase consideration. And you see that when determining the purchase consideration, number 1, you determine the amount payable to the ordinary shareholders. the amount payable to preference shareholders, amount payable to debenture holders, and the dissolution cost. So you are told that, let's go to additional information. Additional information. The authorized share capital of the new company was 120 million, comprising of 12 million ordinary shares of shillings 10 par value. Number two, the preference dividend in B Limited. So we start with two preference shareholders, and we have their dividends. So let's separate them. The one amount to pay to B Limited, the amount to pay to H Limited. Since we have the two companies, we shall pay them separately. So the preference dividend of B Limited were 3 years in arrears, while in H Limited preference dividend had not been paid for 2 years, including the current year to 30th September 2015. So first of all, let's get the preference dividend in arrears. So in B Limited, they were 3 years in arrears. So let's go to preference share capital. You'll take 7.5. You multiply by 10,000, and then they have not been paid for 3 years. That is in B. In H, it's 7.5. How much is the preference share capital of H? 24,000. But for them, they have not paid for how many years? 2 years. Then you are told that, still at note number 2, only 20% of the arrears of preference dividend were settled by the issue of ordinary share of shillings 10 each in S Limited. Only 20% were settled. So once you get the dividend, you take 20%. So that means in B, how much do you get? I'm getting 450. Then in H, was it 3 or 4 years? That's okay. I'll have 720. Good. Number 3. S Limited issued 3.4 million ordinary shares. So, and the dividend were paid through the issue of what? Can we go back to note number 2? The preference dividend of B Limited were 3 years in arrears, while in H Limited, preference had not been paid for 2 years, including the current year to 30th September 2018. Only 20% of the arrears of the preference dividend were settled by issue of ordinary shares. So this amount was paid through the issue of ordinary what? Ordinary shares. In short, the preference dividend in arrears, the preference dividends in arrears for B and C, they were paid through the issue of ordinary share in S Limited. Number 3, S Limited issued 3.4 million ordinary shares of shillings 10 each at 5 in favor of the preference shareholders in both companies. Still to preference shareholders, they were given ordinary shares. How much? They were given 3.4 million shares, each at 10, each credited at 5. Are you together? Each credited at 5. So what do you get? You get 17,000. Are you together? Then you are told that the ordinary share were allotted on the basis of preference share held in the old company. You see, S Limited issued a total of that 400 for both B and H. How are they allotted? You are told that it was allotted on the basis of preference share held in the old company. So just get the proportion. So in B, in H, can you add the total preference share capital? Preference share capital, you'll take 10 plus 24, you get 34. Then you get the proportion. So this one will take 10 over 34, and this one will take 24 over 34. Then you multiply by 17, you multiply by 17. So that means of the 17,000, you multiply by 10. Here you get 5,000. So that means it will be 12,000. Then you're told that, still at note number 3, the ordinary shares were allotted on the basis of the preference share held in the old companies. The preference shareholders committed to immediately pay the balance on the share issued. You see, in this case, they were given that 400 shares, each at 10, but they only paid how much? 5. It was allotted at 5. So there is a balance of 5 to make the shares fully paid, which will be paid by the preference shareholders upon the receipt of the shares. Number 4, the bond holders. So now we have moved to bond holders. The board holders. So the board holders in both companies were settled immediately by the new company issuing ordinary share of shillings 10 each to satisfy the nominal value of the bond. So for them, they were paid in full because they were given ordinary share to satisfy the nominal value of the bond. So how much was the nominal value of the bond in B? 20,000. So in short, B was given shares worth 20,000 and H was given shares worth how much? 15. Then number 5, the new company also issued 4.6. The new company also issued 4.6 million ordinary shares of shillings 10 each, credited at 2.5 each in the favor of ordinary shareholders in the old companies. So now we go to ordinary shareholders. They were given ordinary shares. They are told that the new company also issued 4.6 million ordinary shares of shillings 10. So it's 4.6 each at 10. That means the ordinary share their shareholders in B and S, B and H, they were given shares worth 46,000. How are they allotted? The ordinary share were allotted on the basis of the ordinary share held in the old company. Can you go to the ordinary share capital? We had 30 and the other one had 16. So can you get that proportion? 30 over 46, you multiply by 46,000. So the first one you multiply by 30 over 46. That will be in B. There you get 30,000. Are you getting 30? Yeah, it's 4.6 each at 10. Yeah, you get 30. So the balance will be 16. Good. Then number no. We have missed. Can we go back to note number 5 again? The new company also issued 4.6 ordinary share of shillings 10 each, credited at 2.5. Each share was credited at 2.5, not at 10. It's at 2.5. So determine the amount of ordinary share and then your portion. Then you are told that the ordinary share were allotted on the basis of the ordinary share held in the old companies. Then the ordinary shareholders were to pay the balance on the share immediately. So it was allotted at 2.5, but the par value was 10. So there is a balance of 7.5. So you'll take 4,600. Each was created at 2.5, and then your portion. You'll have 75. You'll have 4,000. Good. Number 6. The current liability of the old companies were transferred to the new company at their book value. Then number 7. The copyright in B Limited expired upon amalgamation, so that means it was written off. The old companies, of the old companies, and therefore were to be written off. Number 8. The tangible assets were taken over by S at their fair values as follows. So you're given that. Number 9, liquidation expenses. We say that liquidation expenses form part of purchase consideration. And we say that the liquidation expenses or the formation expenses will be treated as part of preliminary expenses. So liquidation expenses of B and H Limited amounted to 8 and 5. So 8 and 5 respectively were paid by S Limited and treated at a preliminary expense. Assume that all the above transactions were completed by the close of business on 30th September 2018. So how much will be the value of the purchase consideration? So on amalgamation, B Limited was paid how much? By S as well as H Limited. So it's 450. Here we have it's 40, 950. Here we have 36, 720. Yeah, and the total purchase consideration now paid by C, paid by S, will be 77,670. This is the amount S paid to acquire both B and H. So now let's answer the question. So required, the following ledger account in a columnar form to close off the books of B Limited and H Limited. So let's start with the preference shareholders account. Preference shareholders account, and determine the balance brought down. How much is the balance brought down? Preference share we had 10,024. Then they also had another claim, dividends in arrears. In B, so let's be here, they had a dividend in arrears of amount of how much? Just compute, it's 7.5 times 10 for 3 years. They had been not paid for 3 years. So it's 0.075. You multiply by 10,000, then they had not been paid for 3 years. So here you get is 2250. Then in H Limited, it's 0.75. You multiply by 24, they are not been paid for 2 years, 36. So that means by the close of the business, they had a claim of how much? So H had a claim of 27,600 and B had a claim of 12,250. How are they paid? Number one, they were paid through the issue of ordinary shares by S. Let's go to a purchase consideration account. To preference shareholders. For the dividend, they were paid through the issue of ordinary shares. B 450, H 720, 450, 720. Also, the preference share to satisfy their par value, they were given also additional ordinary share. B Limited 5,000, H Limited 12,000. So they also given additional share 5,000, and here we have 12,000. So how much do they expect to realize? So we say that the balancing figure is realization. So how much do they expect to realize? Here we have it's 14,880. Here we have it's 68. Let's go to the ordinary shareholders. You do the same. You start by determining the balance brought down. Ordinary share capital, how much was the opening balance? We had 30,000 and 16,000. Still under the equity. Do they have any other claim? Yes, share premium is part of the shareholders' wealth. Share premium, an amount of 1,600 and 1,400. Then we have retained profit or losses. So that is part of shareholders' wealth. But in this case, you debit accumulated losses, an amount of 23,434, 300. Then did we have any intangible asset written off? Yes. Can you go to note number what? Do you have any goodwill? You say that whenever you have any construction, you have to write off the goodwill. or the intangible asset. Can we go to note number 7? The copyright in B Limited expired upon amalgamation of the old bond, and therefore they were to be written off. So copyright written off. So how much was the value of the copyright? 8,400 dash. So that means by the close of the business, they had a claim of 17,400. They had a claim of 31,600. Then of the balance, they were paid through the allotment of ordinary shares. Can you go to the purchase consideration workings? So to ordinary shareholders, they were given ordinary shares, 7,500 and 4,000. 75, 4,000. So the balancing figure, what you get as a balancing figure is what you take to the realization account. I think in this case should be on the debit side. The credit side is, the debit side is more than the credit. So that means our realization will be on this side. Realization account. So that 8,300 to minus 16 to minus 14. So here you have 2,900. Take it to the realization account. So here we get that 9,300 minus that 1,600. You'll get 77. So now let's, number 1, realization account. We say that how do you present the realization account? You debit all assets at their net book value. So what do you have to the assets? We had PPE. B Limited, the value was 16,512. Then intangible assets, remember they were written off. Do you have any current assets? Yes, we had current assets. And under the current assets, we had 52,500. And we have 30. Then we see that you also debit the liquidation expenses, because it will be part of preliminary expenses. And how much was the liquidation expenses? B, we incurred 8 million, and H, we incurred 5 million. Also, we factor in the dividend in arrears. Yeah, the preference dividend in arrears. So let's be here in the preference shareholder sundry account. The dividend in arrears here we had 22.50, and in H Limited was 36. Then on the credit side, we see that you present the liabilities, the current liabilities. So do we have any current liabilities? In short, what I'm doing, I'm taking the assets minus the current liability so that we can get the net asset. But in that case, can we go to note number 6? Note number 6. The current liability of the old company were transferred to the new company at the book values. We had trade payables. Trade payables, 37,200, 18,400. Then we have bank overdraft, an amount of 2,000. Here we have 1,500. Then if you take asset minus liability, you get the net asset. Then you compare against the purchase consideration. You also factor in the purchase consideration. And how much was the purchase consideration? We computed in a working number 1. B Limited was 40,950, and H was that 67,20. Then we close off the accounts. Let's be here. preference share account, we had a balancing figure. We said that you take it to realization account. So you debit the preference share account, you credit realization account. So here we had preference share account. B limited is 6,800 and H limited is 14,880. Then from the ordinary shareholders member account, our realization balance was on the debit credit side. So that means you debit on the realization account. So you show that ordinary share capital account 77,20,900. So let's balance that account. So yeah, I'm getting is 86,950. Good. The realization account, remember, it should balance 950. $71,500. Good, 71,500. Good, you can take a screenshot of that. Let's take a screenshot. Good. So now let's present part B. Part B of the question, they wanted the journal entries to record the journal entries in the book of S to record the transfer of assets and liabilities. Ignore narration. So how do we prepare the journal entries? So that for the journal entries, number one, you need to show the assets taken over. Number two, liabilities taken over. Number three, you determine the goodwill. And then number four, you show the purchase consideration. So number B, journal entries. It's all about debiting and crediting. So number one, you assets taken over. You see that for the assets taken over, what do you debit? You debit business purchase account. Sorry, you debit asset to create the business purchase account. So you debit the assets. What were those assets? Can you go to note number 8? Note number 8. The tangible assets were taken over by S Limited at their fair values as follows. So we had PPE, and also we had what? Current assets. And in this case, we are preparing in the book of S. So can you add the total? PPE, you add 12,500. Then you add 95, and you get? That is 23. Are you together? 22, eh? Is that 22? 22,000. Then we have the current assets. You do the same, 58. You add that 8.6. 96,600? 96,600. You debit the asset, you credit the business purchase account. Can you add the total? 118? 118,600. Then there is another asset we need to capture, the preliminary expense. We see that the resolution expense or liquidation expenses should be treated as a preliminary expense. So in this case, you debit the business purchase account. And how much was the liquidation expenses? We had 8 and 5. So that was note number 8. Liquidation expense of B and H was 8 and 5, which were paid by S. So in short, S paid an amount, a total of how much? 13. Then you credit cash account. Then number 2, you need to record the liabilities taken over. We say that for the liability, you debit the business purchase account. Business purchase account, you credit the liabilities. How much was the liability? Can we go to note number 6? Note number 6. The current liability of the old companies were transferred to the new company at their net book value, at their book value. So let's go to the current liabilities. We had trade payables. They were transferred at their book value, and also there was bank overdraft. Overdraft. So payable, you add the total, it's 37,200. You add 18,400. You get amount of 55,600. That one you are crediting. Then bank overdraft, we have 2,000 plus 15, and you get 30. Can you add the total? Then you debit in the business purchase account. 59,100, right? 59,100. Then number 3, you are to determine the goodwill. And how to determine the goodwill? Is the difference between the purchase consideration and the net asset acquired. How much is the purchase consideration? So let's be here. For the working of the purchase consideration, S Limited paid a total of 77. Yeah, paid an amount of 77,670. You raise the net asset acquired. How do you get the amount of net asset acquired? Asset minus liabilities. So in number 1, we have the assets taken over, and the value was 118,600. Then you capitalize the preliminary expenses of 13. You get the total assets. Then you minus the liability. Number 2, the liabilities taken over, the value was 59,100. That's how you get the net asset. You take the asset minus liability. So in that case, you take 118,600, you add 13, then you raise liability of 59,100. Then you compare against the amount paid of 77,670, and you get a goodwill of 51. Yeah, 51,70. So we say that it's a goodwill. Goodwill is an asset, therefore you debit the asset. So goodwill, we have a goodwill of 51,70. You credit the business purchase account. Business purchase account, an amount of 51,70. Then lastly, number 4, you show the amount of the purchase consideration. And you see that for the purchase consideration, you debit the business purchase account. You credit vendor's account. So, and a business purchase consideration was an amount of 77,670. The vendors 77,670. Good. Can take a screenshot of that, or before that? Yeah, just take a screenshot of that before I wrap it. Good. So now let's present number C. Number C, they wanted opening statement of financial position. Statement of financial position. So it will be for S Limited. Statement of financial position. As at 1st October 2018. Assets, we start with non-current assets. Note number 8, the tangible assets were taken over by S at the following fair value. So number 1, we had PP. So add the total, how much was it? Was it 22? It's 12,500, you add 95, which is 20? 22. Then we had goodwill. We have computed goodwill. How much was the value of the goodwill? 50? Was it 50? Actually, it's here, 5170. Yeah? 5170. And then we had liquidation expenses. We said liquidation expenses should be capitalized as part of preliminary expense. Preliminary expenses. 8 plus 5. And you're having how much? 13. Then let's go to the current assets. The current assets still at note number 8. It's 58. You add that 8.6. How much do you get? 90? 96,600. And then we had cash. I'll show you how to get cash. Then let's go to equity and liabilities. Under equity and liabilities, AS Limited paid issued shares. They never issued any preference share. So they paid the shareholders in B and H through the issue of ordinary share. So we have ordinary share capital. Then do you have any non-current liability? No. They only took over the current liabilities. Under the current liabilities, what do we have? Yeah, we had trade payables. Remember that current liabilities were taken at their book value. We had trade payables, and also there was bank overdraft. Trade payable, you had the total? That's 7,200 plus 18,400. You are getting how much? 55? 55,600. Then bank overdraft we have 35. So let me show you how to get cash. Do you have any cash? Can you go to note number 3? Note number 3. Note number 3. S Limited issued 3.4 million ordinary share of shillings 10. Are you together? Credited at 5 each in the favor of the preference shareholders in both companies. The par value was 10, but they were credited at 5. The ordinary share were allotted on the basis of the preference share held in the old companies. The preference shareholders committed immediately to pay the balance on the share issued. So we had ordinary shares from the preference. They issued 3.4, was credited at 5. So the balance of 5 they were to pay in cash. So you multiply by 5. How much do you get? Is that 17,000? 17. Then number what? Number 4. The bondholders in both companies were settled immediately by the new, so that one does not affect. Yeah, let's go to note number 5. The new company issued 4.6 million ordinary share of shillings 10 each, credited at 2.5. So the par value was 10, but was credited at 2.5 in the favor of ordinary share in the old companies. The ordinary share were allotted on the basis of the ordinary share held in the old companies. The ordinary shareholders were to pay the balance on the share immediately. So ordinary shares, they were issued with 4.6 million shares, of which was credited at 2.5. So there was a balance of how much? 7.5. They were to pay that in cash. You get 24? 34,500. And then you deduct liquidation expenses. And S Limited paid 8 plus 5, and you get how much? 13. So how much with the balance of your cash? That's it? That 8,500. So we have a cash of that 8,500. Then we also need to get the ordinary share capital. So also let's get the ordinary share capital. That's very easy. So that's why I have not named the purchase consideration. Let's be here. Under the purchase consideration, We issued ordinary shares to pay off for preference shares. And in B, we issued shares worth how much? 450. And also in H, an amount of 720. How much is the total? Yeah, we issued shares worth 1170. Then also we issued an additional ordinary share 3.4, which was created at 5. But we see that the ordinary share capital showed them at power. It was created at 5, but they paid the balance of 5 later upon the receipt of the share. So that means the share is fully paid. That 400 times 10 you get? That 4,000. Also, to bondholders, we issued ordinary shares. Bondholders, we issued shares worth how much? 20 plus 15, of which is 30. 35. And then the ordinary shareholders, we issued them 4.6. They only paid 2.5, but they paid the balance in cash. So that means the shares are fully paid. You multiply by 10, you'll get 46,000. So how much is the ordinary share capital? You get 116? 116, 1? Yes, 116, 170. 116, 170. I don't think we should any preference shares. So let's try to balance that. 116, 170. You add 55,600. You add that 500. I'm getting 175 to 70. There is something we have not inserted. What is that? Yeah, so this one was not supposed to be, it's 22,000, right? Yeah. Good. It's 175 to 70, just balanced. So you can take a screenshot of that and kindly do a lot of practice for external reconstruction. So take a screenshot. And that marks the end of that session. So in our next session, we'll be doing EPS. So kindly go through EPS.